Farm income can swing wildly, so the tax law gives farmers a few special pressure valves. The big three you'll see on the EA exam are disaster-related deferral for excess livestock sales, the election to postpone crop insurance or disaster proceeds, and Schedule J farm income averaging. These don't make income disappear. They mainly shift timing or spread income across years to reduce rate pain. First, postponing gain when weather forces excess livestock sales. If drought or flood makes you sell more animals than normal, a cash basis farmer can push the extra income into the next year. Exam tip: they love the checklist. Principal business must be farming, cash method required, and you must prove the extra sales happened only because of the weather event in a federally designated disaster area. Two details are easy to miss. 1. You compute the postponed amount separately by class of livestock: cattle, hogs, sheep, and so on. 2. You must attach a statement to the return for the year of sale describing the weather conditions and the computation. Also, the animals don't have to be raised or sold inside the disaster area. The key is that the weather condition affected water, grazing, or similar needs. Next, crop insurance and government disaster payments. Normally, insurance proceeds are taxable when received, but a cash method farmer can elect to postpone reporting to the following year if, under normal business practice, the income from those damaged crops would have been reported in the year after the damage. That's the core concept. You're matching the insurance to the year you would have sold the crop. To make that election, the proceeds must be received in the same year the crop was damaged, and you attach a statement listing the specific crops and total payment. And you need support that the crop would have been harvested or sold the next year. One more trap: if the farmer doesn't plant and instead receives agricultural program payments, those are reported on Schedule F and are subject to self-employment tax. Now, Schedule J, farm income averaging. Farmers can choose to average all or part of current year farm income by spreading it back over the prior 3 years, called base years, using those years' tax rate brackets. It's not an income deferral, it's a rate play. On the exam, focus on the concept. It helps in a spike year by taxing some of that spike as if it happened in lower income years. Finally, a few farmer-only breaks to recognize. There's a quirky vehicle rule. If a car or light truck is used most of the business day in farming, the farmer can treat 75% as business use without logs. Soil and water conservation costs can be deducted as business expenses, things like leveling or windbreaks, where other businesses might have to capitalize. And farmers may claim credits or refunds for federal excise tax on fuel used on the farm. Marcus owns a barbershop with 10 employees. In 2023, his gross revenues are $900,000. He spends $24,000 modifying the shop to provide restroom access to customers with disabilities. What is the amount of Marcus's disabled access credit? The choices include not eligible, $5,000, $24,000, or $12,000. Think about it. The credit is $5,000. The disabled access credit is generally 50% of eligible costs over $250, limited to $10,250 of expenditures, so the maximum credit is $5,000. Marcus qualifies as a small business because gross receipts are $1 million or less, or 30 or fewer full-time employees. A tempting wrong answer is $12,000, but there's a hard cap. Cedar Ridge Farms built a barn years ago for $50,000. This year it's worth $70,000. Then it's destroyed by a tornado. At the time of the tornado, the adjusted basis is zero because it's fully depreciated. Insurance pays $70,000 and the farm spends $66,000 to rebuild. What's the tax consequence? Options include recognizing all $70,000, recognizing only $4,000 with deferral, or treating it as non-taxable. Think about it. Recognize $4,000 of income, and the remaining $66,000 gain can be deferred. This is an involuntary conversion under Section 1033. With basis of zero and proceeds of $70,000, realized gain is $70,000. Because only $66,000 was reinvested in qualifying replacement property, the unreinvested $4,000 must be recognized now. A tempting wrong answer is non-taxable. but you only get non-recognition to the extent you reinvest.